$100 silver has already arrived across much of the world, even if headlines in some countries pretend it has not. In at least 14 nations, the effective price of silver has already crossed that threshold once currency effects, premiums, and local market conditions are accounted for. While central banks face legal subpoenas, while registered inventories quietly disappear, and while entire nations are paying double-digit premiums simply to secure physical metal, the real question is not whether silver has touched $100. The real question is, what happens when the global business community realizes their currency can no longer buy what 1 ounce of silver used to cost? And even more urgently, what happens when institutions with billions to deploy discover there is not enough metal left to fill their orders? Welcome to the era of boring currency. If you're old enough to remember when a $100 bill actually meant something, when it could fill a gas tank, cover a week's groceries, and still leave change, then you already understand that world no longer exists. This channel exists for people who recognize that shift and refuse to be the last ones holding paper that steadily loses purchasing power. The focus here is not hype or click chasing. It is capital flows, supply chains, and monetary reality. What is happening to silver is not isolated to one country. It is global, synchronized, and structural. Now let's get into what institutions hope you ignore. The United States Department of Justice served grand jury subpoenas to the Federal Reserve. Not quietly, not through back channels, but publicly. The chair of the central bank responded in front of cameras, framing the legal pressure as being tied to interest rate decisions. Within 48 hours, gold and silver markets began moving in ways veteran traders immediately recognized. This was not speculation. This was repositioning. When the institution that controls the world's reserve currency faces the possibility of criminal investigation, markets do not debate legal nuance. They ask one simple question: can monetary policy still be trusted? Once that question enters the room, confidence begins leaking out of bonds, out of currency markets, and into assets that cannot be printed. Silver closed the week in the low 90s per ounce. This move also carries a signature that separates it from ordinary volatility. The price action is multiple standard deviations above historical norms. The gold to silver ratio has compressed into the low 50s, meaning silver is outperforming gold. That compression matters. Gold typically leads when fear drives demand. Silver leads when the move broadens, when industrial reality collides with monetary distrust, and when the market begins pricing scarcity instead of safety alone. Right now, silver is leading. That leadership should concern anyone holding large cash positions, because leadership changes in metal markets do not happen by accident. They happen when supply constraints meet surging demand. They happen when the physical world calls the paper world's bluff. On financial television, analysts have started using phrases like once in a generation and secular trade. They are accidentally telling the truth. Monetary regime shifts do not arrive on schedules. They emerge when structural imbalances reach their breaking point. And the imbalance here is straightforward. The world has underinvested in mining capacity for more than a decade, while simultaneously increasing its dependence on silver for technology, energy systems, electronics, and industrial applications. You cannot print your way out of a supply deficit. You cannot stimulate a mine into existence. You cannot issue a press release and summon metal from the ground. New mine production timelines range from 7 to 15 years. Even if capital flooded into exploration today, the supply response would not arrive until the early 2030s. Until then, the market has only one tool to ration demand: price. And price is doing exactly what it must do. Some will argue this move is speculative excess. They will say retail enthusiasm has pushed prices beyond reason and that a correction is inevitable. Volatility is inevitable. But volatility within a structural uptrend is not the same as a trend reversal. Pullbacks shake out weak positioning. They transfer metal from impatient hands to patient capital. They do not eliminate the underlying drivers, and those drivers remain firmly intact. Trust in central banking is deteriorating. Political pressure on monetary policy is intensifying. Industrial demand for silver continues, regardless of investment sentiment. Supply remains constrained. Inventories are falling, not rising. That combination does not resolve with a single down week. It resolves when price climbs high enough to destroy demand or unlock new supply. Neither is happening yet. This is why silver approaching $100 matters. Not because it is a round number, but because it forces a psychological reset. Once the market accepts that $100 barely buys an ounce of silver, the conversation changes. People stop asking whether silver is expensive and start asking what $100 will buy next year. Once that question spreads, it becomes contagious. Early positioning is happening quietly. Institutional allocators are beginning to evaluate hard assets not as crisis hedges, but as baseline portfolio requirements. Sovereign wealth funds are watching. Pension managers are watching. Corporate treasuries are watching. They are not buying aggressively yet, but they are watching. And when institutions of that scale decide to enter, they do not accumulate gradually. They establish positions. In markets with limited physical supply, price does not drift higher. It gaps. There is one number that should terrify anyone paying attention: 70 million ounces. That is how much registered silver, the metal that can actually be taken for delivery, has vanished from major Western vault systems in recent months. Not reclassified, not moved, gone. Registered inventory is the metal that backs the paper market. It is what gives futures contracts credibility. It is the reserve that allows exchanges to function without breaking. When that reserve shrinks by tens of millions of ounces while prices are rising, it means someone is aggressively converting paper exposure into physical metal. Most investors never think about vault categories. They see a price on a screen and assume it represents available supply. But the silver market operates on two levels. There is the paper level, where contracts trade electronically with leverage and positions can be opened and closed without a single ounce changing hands. Then there is the physical level, where metal must be sourced, allocated, transported, and delivered. Those two levels are supposed to stay connected. Right now, they are diverging. The divergence shows up first in premiums. Premiums are what you pay above the official spot price to actually obtain metal. When premiums are low, the physical market is calm. When premiums spike across multiple regions simultaneously, it signals stress. That is exactly what is happening now. China has been paying persistent double-digit percentage premiums over international spot prices. At times, those premiums have exceeded 10%. A market willing to pay that much more simply to secure physical delivery is a market that does not trust paper promises. And even while paying those premiums, Chinese inventories have been falling. Visible stockpiles in the Shanghai Futures Exchange System are now below 40 million ounces. The world's largest industrial economy is paying premium prices and still draining inventory. That is not temporary, that is structural. India tells a similar story. Over recent months, Indian silver investment vehicles have absorbed more than 50 million ounces. In a single month, inflows exceeded 20 million ounces. That is nearly half of what some countries hold in strategic reserves. This is not speculative trading, it is allocation. Indian investors, with generational experience in precious metals, are moving capital into silver because they see currency risk, understated inflation, and a metal that holds value when paper does not. Combine those two demand centers: China draining inventory while paying premiums, India absorbing tens of millions of ounces. Then ask the obvious question: where is that metal coming from? Global mine production has not surged. Recycling has not exploded. The metal is coming from existing stockpiles, warehouses, vaults, and reserves that were supposed to cushion the market during stress. Those reserves are shrinking fast. Silver is also fundamentally different from gold. Gold is stored. It moves between owners, but it does not disappear. Silver is consumed. It is embedded in electronics, solar panels, medical devices, batteries, and industrial systems in quantities too small to economically recover. Once used, it is gone. This is why silver has been running structural supply deficits for years. Annual demand exceeds annual production, and the gap is filled by drawing down inventory. Every year, the cushion gets thinner. Lease rates for physical silver have been spiking in key financial hubs. Lease rates are essentially the interest rates for borrowing metal. Rising lease rates signal scarcity. They also indicate stress in the arbitrage mechanism that normally keeps paper and physical prices aligned. When that mechanism runs out of available metal, divergence becomes unavoidable. This matters for positioning. Paper exposure depends on a system increasingly struggling to deliver physical metal. Physical ownership represents an asset that multiple regions are willing to pay premiums to acquire. When the next wave of demand hits, not everyone will be able to convert promises into metal. Even traditional safe havens are failing. Measured against silver, the Swiss franc has lost more than 30% of its purchasing power in less than 2 years. If the world's most trusted fiat currency is bleeding value against a metal, this is not a localized problem. It is a fiat system problem. This repricing is happening everywhere. Every currency is being debased, some faster than others, but all in the same direction. The numbers rise, but the value shrinks. Silver and gold simply expose the reality. That is the shift underway. And once the market fully accepts it, the old ceilings will not return. The only way to see what is happening clearly is to stop measuring value in currency units and start measuring it in ounces. Currency is a moving target. Ounces are not. Once you make that mental shift, patterns that were previously hidden become obvious. Let's apply this framework to something tangible: real estate. Specifically, the number of silver ounces required to purchase a median-priced home in the United States. In the year 2000, it took roughly 15,000 ounces of silver to buy a median home. By 2011, during the last major silver spike, that figure collapsed to around 5,000 ounces. Silver had not merely risen in price, it had gained real purchasing power against housing. After 2011, the ratio climbed again as silver corrected and home prices surged. But now in 2026, that ratio is compressing once more, and it is compressing rapidly. That compression tells you something critical. Silver is not just rising nominally. It is gaining real purchasing power. Its ability to buy hard assets is increasing. Historically, when this ratio approaches inflection points, it does not gently reverse. It accelerates. Once people recognize that metals are outperforming real estate, capital reallocates. Reallocation creates momentum. Momentum creates scarcity. Scarcity drives price acceleration. This is how regime changes compound. This is where informed capital separates from reactive capital. During regime changes, the old rules stop working. Correlations break down. Assets that once moved together begin moving independently. Safe havens stop behaving like safe havens. Assets that were ignored for decades suddenly become essential. For years, conventional wisdom held that stocks and bonds balanced each other. When stocks fell, bonds rose. When bonds fell, stocks rose. That relationship defined portfolio construction for decades, until it didn't. In 2022, stocks and bonds fell together. The 60-40 portfolio, the foundation of modern wealth management, failed because the regime shifted. Inflation returned, and inflation does not care about portfolio theory. Now we are in the next phase. Inflation, as measured by official statistics, appears to be moderating. But currency debasement is accelerating. These are not the same thing. Inflation measures the rate at which prices rise. Debasement measures the destruction of purchasing power. You can have relatively low reported inflation while still experiencing aggressive debasement if the currency unit itself is being diluted. That is exactly what is happening. Governments are spending more than they collect. Central bank balance sheets remain expansive. Deficits are structural, not cyclical. Currency supply continues to grow. When supply grows faster than demand, value falls. That is basic economics. Yet people still express surprise when metals rise. What happens next follows a pattern, not a prediction. When a currency loses purchasing power, people notice gradually. First, groceries become more expensive, then fuel, then rent, then insurance. Eventually, everything costs more. But people still think in currency terms. They say prices are rising. They do not yet recognize that the money itself is losing value. That realization comes later, and when it comes, it arrives all at once. Suddenly, people stop asking how much silver costs and start asking how much their currency can buy. That psychological shift is the moment wealth transfers from those who held paper to those who held metal, from those who waited for confirmation to those who positioned early, from those who trusted institutions to those who trusted mathematics. You can change inflation definitions. You can adjust CPI baskets. You can revise employment data. You can rework GDP calculations. But you cannot print ounces. You cannot revise scarcity. You cannot negotiate with supply. When more currency chases fewer ounces, the price rises. That is not sentiment or speculation. It is arithmetic. And arithmetic does not negotiate. The uncomfortable truth is that most people will recognize this too late. They will see silver at 150 and say it is too expensive. They will see it at 200 and say it is a bubble. They will see it at 300 and finally panic buy at the worst possible moment. Human psychology does not change. People chase performance. They avoid volatility. They seek consensus. By the time consensus forms, the easy gains are already gone. That is why positioning matters now. Not when financial media finally admits what is happening. Not when neighbors start talking about silver. Not when institutional allocations become public. Now, while the move is still being dismissed. While analysts still call for corrections. While the crowd debates whether $100 is justified. The crowd is always wrong at turning points, not because it is foolish, but because turning points require seeing what is not yet obvious. And what is not yet obvious to most is that this is not a commodity rally. It is a currency crisis unfolding in slow motion, one that gives you time to position, but not unlimited time. Once institutional flows arrive in force, once sovereign buyers enter aggressively, once the scramble for physical metal becomes urgent, the window closes, and it closes violently. The question then is not whether silver will pull back. The question is whether you are positioned for what happens when the world realizes its currency cannot buy what it used to. That realization is coming, and it will not wait for comfort or consensus. Every major market shift has a defining moment. It is not when the trend begins. It is not when early adopters move. It is when institutions arrive. And institutions are beginning to move quietly, methodically, but unmistakably. Pension funds that have never held precious metals are now running allocation models. Sovereign wealth funds that dismissed hard assets for decades are requesting physical delivery timelines. Insurance companies bound by conservative mandates are exploring regulatory pathways to hold bullion. This is not speculation. It is reallocation. When institutions reallocate, they do not buy one contract at a time. They do not accumulate slowly over years. They establish positions in size all at once because their mandates require efficient deployment of capital. Consider the math. A mid-sized pension fund managing $20 billion decides to allocate just 2% to precious metals. That is 400 million. Now, imagine that order entering a silver market where registered inventories have already fallen by 70 million ounces, where China is paying double-digit premiums, and where India has absorbed more than 50 million ounces in months. In that environment, price does not drift higher. It gaps. There's simply not enough available metal to absorb that demand without violent repricing. And once one institution moves, others follow. Not because they independently reach the same conclusion, but because they cannot afford to underperform peers. This is institutional herding. No one wants to be first, but no one can afford to be last. That is the setup we are approaching. Now consider supply response. The natural assumption is that high prices bring new supply. That logic works for many commodities. It does not work well for silver. Mining does not respond quickly to price signals. From exploration to production, a new silver mine takes 7 to 15 years to develop. Geological surveys, permitting, environmental reviews, community approvals, infrastructure, financing all take time. During that time, demand does not pause. Industrial demand continues. Investment demand continues. Inventory continues to drain. Even if capital floods into silver exploration today, the supply response would not arrive until the early 2030s. Until then, the market has one mechanism to balance supply and demand: price. Price will rise until one of two things happens. Either demand is destroyed or existing supply is reallocated. Demand destruction means industrial users cutting back, manufacturers redesigning products, and technology firms reducing silver usage. That process also takes years. You cannot redesign solar panels or re-engineer electronics overnight. So demand destruction, even if it begins, will not offer immediate relief. That leaves reallocation. Existing holders selling to new buyers? And reallocation only happens when price rises high enough to convince holders to part with metal. That is the phase the market is entering. To understand what comes next, it helps to think in scenarios rather than predictions. In the first scenario, controlled repricing, institutional adoption proceeds gradually over 12 to 18 months. Price moves through psychological levels like 100, 125, and 150 with periodic corrections. Physical shortages remain localized. Premiums stay elevated but manageable. The paper market remains functional. This is the most orderly outcome, and it requires one critical condition: no shocks, no geopolitical disruptions, no financial system stress, no major policy errors. Historically, that is a tall order. In the second scenario, disorderly acceleration, something breaks. A geopolitical event disrupts supply chains. A major financial institution fails. A central bank loses control of currency stability. Or a large sovereign buyer enters the market aggressively. In this case, institutional demand floods in simultaneously. Prices gap higher. Liquidity evaporates. Physical premiums surge into the 20 to 30% range. Paper markets begin to fracture with settlement delays, delivery failures, rule changes, margin hikes, and potentially trading halts. This is not theoretical. It happened in nickel in 2022. It happened in European natural gas markets. When physical markets dislocate from paper markets, the consequences are severe, and paper exposure proves very different from physical ownership. In the third scenario, policy intervention, governments decide, rising metal prices threaten currency confidence, and intervene. This can include strategic reserve releases, export controls, transaction taxes, or regulatory pressure. History provides examples. Gold confiscation in 1933, regulatory actions during the silver market turmoil of 1980, and the London Metal Exchange's intervention in 2022. Intervention can disrupt markets temporarily. It cannot eliminate the underlying drivers. Silver is global. Digital settlement exists. Physical metal can be held outside traditional banking systems. Jurisdictional arbitrage is easier than ever. Scarcity does not disappear because of policy. No one knows which scenario will unfold. Intelligent positioning does not require certainty. It requires understanding asymmetry, holding physical metal rather than just paper exposure, allocating in stages rather than all at once, maintaining liquidity to take advantage of volatility, recognizing that metals are not a trade, but insurance against outcomes most people prefer not to imagine. If the financial system remains stable and currencies hold value, metals still hold purchasing power. You do not lose. If the system fractures, currencies fail, and trust evaporates, metals do not just hold value. They become essential. That asymmetry is why informed capital is positioning now. The question is not whether $100 silver is expensive. The question is whether your currency will still be able to buy an ounce when reallocation is complete. Because once institutions finish positioning, once sovereign buyers secure supply, and once the physical market tightens beyond recovery, the price will not be $100 and the opportunity will be gone.